Good morning, everyone. Welcome back to the Peterson Institute for International Economics for the, if I can use the expression, grand opening of our fall season. And we are very excited to be following the NFL premieres with our own hard-hitting, exciting lineup. I'm Adam Posen, president of the Peterson Institute, and it is really a pleasure today to be able to be hosting the U.S. launch, and I think we're beating the European launch by a few hours, of the Geneva Report, the 10th annual Geneva Report on the World Economy, importantly titled, What Else Can Central Banks Do? This is, of course, an annual, very distinguished series that has been out for many years under the leadership of Charles Wyplosz and CEPR. But through sheer happenstance, or I would argue quality, this year's 4 authors, 3 of them have Peterson Institute affiliations. Joseph Gagnon, of course, is senior fellow here at the Peterson Institute. Patrick Honohan, who will be doing the premiere in Europe, of course, the former governor of the Central Bank of Ireland, is a non-resident senior fellow with us since leaving that post. And Signe Krogstrup, here with us this morning as well, was a visiting fellow here last year while the report was written. We then decided, in the spirit of fighting against Brexit, to let Larry Ball immigrate across the border from Johns Hopkins and join us. Joking aside, I'm very proud that we've assembled, both directly and indirectly, such a great group of applied monetary economists and policymakers who are bringing real analytical work to bear on this question of the central bank toolkit. As many of you know, and certainly all of you have read, there is a great deal of fuss being made that central banks have reached the limit of their powers to stimulate their economies, in the major economies. This, of course, as it should be, gets conflated with other questions. The question of should central banks be doing more? And then the question of, is it optimal? Wouldn't it be better if, like the G20 says, we all used fiscal policy instead of monetary policy to achieve our goals at this point? Those are legitimate questions, and those are obviously going to be part of the consideration of this issue. But the report that we have is fundamentally about the question, what else can central banks do? And I think that that's the important first step that we all have to get with. In particular, retrospectively, to appreciate the effectiveness of central bank action since the crisis, as well as prospectively to think about such things as further negative rates, further asset purchases of varying kinds, and different forms of forward guidance. And so this report, by its own description, is a primer for central banks on how to ease policy when short-term interest rates hit zero. Again, I'm not going to constrain the discussion, but I'm grateful to my colleagues for taking it on in that practical purpose and obviously sticking their necks out in a real way. I'm not going to go through all the bios of the authors. They're all well known to those of us in the monetary policy junkie community. I am, however, going to give a big thank you to our 2 discussants, and frankly speaking, these were my 2 absolute first choice discussants, and we could not have done better. Speaking immediately following the presentation will be Jason Cummins of Brevin Howard. Jason is, by I think all accounts, and certainly by my accounting, the most useful and wise macro monetary economist in the hedge fund space, which undersells, if anything, his contributions to the public debate and to private conversations that he has that enlighten all of us. He does a wonderful job of combining analytics with market sense, and I'm sure he will have some appropriately critical and questioning comments for the authors based on his unique insights. Following Jason, as almost no one else could, is, of course, Professor Carmen Reinhart of the Harvard Kennedy School of Government. Carmen is, at this point, more distinguished than I can care to recall. She was recently here a senior fellow at the Peterson Institute, the Dennis Weatherstone Senior Fellow, succeeding Morris Goldstein. But then she, of course, ascended to Harvard along with the publication of her book with Ken Rogoff, This Time is Different, many other publications, but that, like Friedman and Schwartz, Reinhardt and Rogoff, is now a name that will go down in intellectual history. Carmen, however, is not only looking backwards, she's always looking forwards, and it was very generous of her to come down on short notice from Boston to join us today, and thank you very much for doing that, Carmen. So that being the batting order, I believe, Signe, are you leading off? Dr. Signe Krogstad of the IMF.
Thank you very much for this introduction, and thank you very much for accepting to launch the Geneva report. So before I start, I have to give a disclaimer. I was at the Peterson Institute when we wrote this report earlier this year. I have since joined the IMF, so I have to say that the report should not be taken to reflect the opinions of IMF board or management. And that said, let me start here. So the background of the report, or the starting point of this report, is that the frequency and the cost of the zero lower bound restricting monetary policy have increased. Now, if we, for instance, start out with the neutral real interest rate, let's say that the neutral real interest rate is the interest rate level at which we have full employment and stable inflation around the target. The nominal interest rate can then be seen, or the policy interest rate on average can then be seen as composed of this neutral real interest rate and inflation expectations according to a simplified Fisher equation that I have here on the top of the slide. Now, both of these components of the nominal interest rate or the policy interest rates has come down in recent decades. The neutral real interest rate, there's a lot of current focus and research on the level of the neutral real interest rate. There's a lot coming out documenting that there has been a downward trend in the neutral real interest rate that reflects probably a reduction in a couple of percentage points over the past couple of decades. And adding to that, inflation expectations came down strongly, predominantly in the 90s, when central banks adopted inflation targeting regimes and low inflation targets. So these two factors have combined to bring nominal interest rates down closer to the zero lower bound on average. And that means that the lower bound constraint has become now a frequent reality, whereas before it was considered a theoretical curiosity. And this table here is supposed to show you, or give you a bit of an impression of how the zero low bound constraint has become a reality. It reflects average policy interest rates across 10 advanced economies from 1980 to 2015. And I'm perfectly aware that you can't read the numbers, and that also doesn't matter. What you want to look at is the colors that I have up here. So average policy rates within the year that are below 3% are colored yellow. Policy rates below 2% are in pink, and policy rates at or below 1% on average across a year are in red in this figure. And as you can see, in the 80s, there was barely any incidence of the zero lower bound constraint on monetary policy. And if we were to go further back from that, 70s, 60s, you would see the same thing. That changes in the 90s. In the mid-90s, we have a couple of countries getting dangerously close to the lower bound. The best example, what most well-known example, is Japan, which has been in the lower bound since. In the early 2000s, more countries get dangerously close to the lower bound. And as we're all painfully aware of, since 2008, most of these countries have been in the lower bound and are still there. So the point of this table, I think, is that the fact that we have widespread zero lower bound problems currently is not just an artifact of the global financial crisis. It is something that has been building up over the past decades, and it's likely to continue being a problem even when we get out of current predicaments. So in the report, we want to assess the cost of this increased incidence of the lower bound. And what we do is we estimate a simple macro model, we quantify it for the US, and we assume that the neutral real interest rate is 1% and inflation expectations are 2%. And what we find from this model is that when the unemployment exceeds the NAIRU, or the natural rate of unemployment, by 1.1 percentage points, the nominal interest rate will hit the zero lower bound. That is not a lot. When you look back at the history of US recessions, in 7 out of 8 of the past recessions, that was the case for the US. So that means that if we have similar macroeconomic dynamics going forward, basically we will have the Fed being hit by the zero low bound constraint in basically every recession. We also estimate a counterfactual. That's what I have in the figures here. We assume in the counterfactual that there's no zero lower bound constraint on the policy rate. So on the top chart, I have the federal funds rate from 2008 onwards, and the red dashed line is the historical outcome for the federal funds rate. The blue line is the counterfactual where we allow the policy rate to optimally adjust to the shocks that it was hit by in 2008. And here we find that optimally the policy rate should have been reduced to -6% in 2009. That, if policy could have adjusted in that way and not been constrained by the lower bound, the policy rate could have been increased already 2010 and 11, it would have returned back to positive territory. The mid chart shows the unemployment gap and shows that if we had had this policy flexibility, we would have had a substantially lower unemployment gap throughout this period. The lower chart shows inflation, and again shows that inflation would already in 2011 have gone up compared to where it has been, and would have been on average much closer to the 2% target of the Fed than what we have actually seen. I want to add that these estimates of the cost of the zero low bound constraint are quite conservative. So in the historical case that we're comparing with, we already have a lot of QE and forward guidance. If we had not had that, of course, the cost would have been even worse. We also in this model do not take into account long-term structural effects of having long slumps, how that can affect labor markets. So what are the implications of this? In the report, we look at exactly as Adams put very well just before, what we look at is what can central banks do to nevertheless meet their mandates when they are constrained by the lower bound? And I want to reiterate and emphasize that we have a very clear focus here in monetary policy. That is not a reflection of our views of the policy mix when going into a recession. They're clear, I think I can speak for all of my co-authors, there are clear arguments why fiscal policy can be very useful in liquidity trap type conditions, but that's simply not the focus of the report. We're asking, just as Adam said, what else can central banks do? And with that focus in mind, we argue that unconventional policy measures will be relevant and will be necessary and will be useful going forward. We consider negative interest rates. We also consider how quantitative easing works. We include their helicopter money. We also look at targeted lending of central banks. We consider forward guidance both on policy and on inflation, and we find that these measures can go a long way in alleviating the lower bound constraint in many countries. They will not be sufficient to alleviate the lower bound constraint in all countries, at all times, and for all shocks. There will definitely be situations where this will not be enough. And so we also consider what central banks can do to reduce the incidence of the lower bound. And here we particularly consider or propose that central banks should consider raising the inflation target. And we don't just say inflation targets should now be moved arbitrarily from the 2% to an arbitrary 4%. We suggest that central banks should be considering on a recurrent basis what the optimal inflation targets should be that will allow the central bank to reach its target. And finally, in the report, we also consider long-term implications for monetary policy and the lower bound constraint of switches to post-cash economies and the trends toward using less cash and how economies without cash can function in terms of monetary policy in the future. So what we're going to do in the rest of this introduction of the report is go over these different measures and how we get to our conclusions about them. So I don't have the slide here, so I forgot to switch the slide. That was the slide that I just talked about. So I will go to the next slide. Negative interest rates is where we start. So what we do in the report is we consider the experiences of 5 countries that have recently used or lowered their policy rates into negative territory. And those are the ones that I have in the chart on the right-hand side here: Japan, the Euro area, Sweden, Denmark, and Switzerland. And what we get from considering the experiences of these countries is that negative interest rates or cuts in policy rates into negative territory have worked largely in the same way as cuts in monetary policy interest rates do in positive territory. There are a few things that change, notably in banking. There are some anomalies in banking, but these are not the central part of the transmission mechanism. Large parts of the transmission mechanisms work in exactly the same way as we would expect. We also find that we have not come close yet to the lower bound on interest rates, and that rates probably can be lowered further compared to where they have been lowered until now. Of course, this has to be done with caution if a central bank considers doing that, to avoid the risk of actually hitting a lower bound where you have a large-scale shift into cash. But we argue, and I think many others also argue, that we are not there yet. And finally, the debate has brought up a lot of concerns about negative interest rates. In the report, we consider many of these, or all of these concerns, and we conclude that the concerns are important to keep in mind, but most of them are simply overstated and have not come to bear in the experiences of these countries. And that means that these concerns should not be arguments currently for central banks not to loosen monetary policy through the use of negative interest rates if they need to do so and are constrained on the lower bound. Quantitative easing. So in the report, we also consider the experiences of different countries that have conducted quantitative easing in recent years. We find, and the literature generally finds, that quantitative easing has unambiguously lowered long-term yields on bonds. More broadly, it has affected and transmitted to financial markets in the way that we would expect. When we're considering quantitative easing, we also consider the many concerns that are put out there about the use of this tool. Many of these concerns are very similar to those of negative interest rates, and we consider them in the same way. A particular concern about quantitative easing has been fiscal implications. So we spent some time in the report considering that, and we find that in all plausible scenarios, the use of quantitative easing should have benign fiscal implications. We also find that previous programs have been able to stimulate the economies that have used them for an equivalent measure as shortcuts of about 2 to 3%. That's quite a lot. We also find that there is scope for more in many countries, in particular if countries consider bringing in other assets into the mix of assets that they purchase. We base that assumption on taking an overview of the relevant asset markets in a number of advanced economies. And we find that when we look at the availability of assets in most countries, there is scope for large QE programs, with a few exceptions, perhaps Switzerland. I'm going to hand over now to Joe, who will continue with the forward guidance.
Thank you, Sina, and thanks to everyone for joining us today. The section on forward guidance is a section that we expanded in the latest draft of the paper. Some of you may have seen earlier drafts, and there was a conference to discuss it a couple months ago in Geneva. And this is one of the outcomes, is that we talk a bit more about forward guidance. And there's 2 types of forward guidance. One is I'm going to focus on is forward guidance on inflation. If you could credibly promise to people that you would raise inflation, that would lower the real rate of interest, which should help stimulate economies. And we think that, to some extent, that has worked. I'm going to get to the case of Japan in a minute. But I think the key point here is that you can't just say it and expect expect it to work. You need to actually take actions that will make it work. So you'd need forceful explanation of what you're doing, supporting policies that would actually push you in the right direction to convince markets and actually move us in the right direction. But if you combine it with those actions, it can actually amplify the effects, have some synergy. And I'd like to take a moment to discuss the case of Japan, because this actually is in many people's minds. And the Bank of Japan, 3 years ago, announced that it wanted to raise the inflation target. It was implicitly around 1%, but they weren't achieving it, and they decided to make it 2% and take bold actions to get towards it. And they launched a real major QE program when they did this. And if you look at this chart, the solid line, vertical line, is the month in which Kuroda was appointed governor of the Bank of Japan under Prime Minister Abe. And that's when the new policy was announced. If you look at the key target variable, core inflation, you see a remarkable inflection point at that time. This is inflation excluding energy prices, fresh food, and the consumption tax, which, to some extent, inflation went up because they raised consumption taxes. We don't want to count that, so that's not included. But we do want to count it's a core close to what the U.S. has long said, the Federal Reserve has long followed as core. And what you see is that core inflation rose almost 2 percentage points after this announcement over the next two and a half years. Also, the dashed line is a long-term survey. It's a survey of consensus forecast of what people think inflation will be 6 to 10 years out, so a long-term forecast. And that was falling, and then the survey literally in the month, because this survey only is twice a year, the survey in the month in which Kuroda took over jumped. That's right at the vertical line, and then it continued to rise. And along the way, you see that the rise in inflation wasn't steady, but it was clearly going up. In late 2014, where it sort of dips down a bit, the Bank of Japan announced a new expansion of quantitative easing and sort of got things going again. Late last year, when you see the second sort of tailing off, sort of leveling out of inflation, at a higher level to be sure, but not at 2, the Bank of Japan, people started to expect the Bank of Japan should make another action, take another step. And in January, they did. They went to negative rates, which surprised markets because they had said they weren't going to do that. And it was a very small move from plus 0.1 to minus 0.1 with a lot of exceptions. And it was not well received by the banks, by politicians, by the public. And it has led people to believe that perhaps the Bank of Japan is stuck and it won't do any more. And in the past 6 to 9 months, things have been sort of tailing off. And the Bank of Japan has not decided what it's going to do about that yet. They're about to make an announcement soon. We'll see. But we are worried that they probably should have done either a bigger cut into negative rates or expansion of QE, perhaps into equities or something bold, but they didn't do it. So it shows that, yes, announcements can help you get to your goal, but you need to back them up with actions, and the actions need to be sufficient. You can't stop if you aren't there yet. So a key point which really we couldn't go into as much as we might have liked, because it would really be another paper, is how does this interact with financial stability? There is an issue. This is a big ongoing debate. How should monetary policy respond to financial excesses? People invest in risky assets, maybe take on too much leverage. We think that many people believe that macroprudential tools, things such as loan-to-value limits or capital requirements at banks, are the best tools for this. I believe they can be quite effective, but we don't know, how much effective or how much is needed. People ask, well, if you can't do enough in that space, should you not do the monetary policy you'd like enough for the macro side of the picture out of concern about raising financial stability concerns? Well, this is a debate. This is a major debate, and we felt like we really could not solve it. There's people on both sides. arguing quite clearly that's sort of beyond our ability to go. But we note that it seems that hitting the zero lower bound typically is going to be a problem when exuberance, if anything, is too low, when people are not overly optimistic. And we also think that if your economy is weak, it's sort of not obvious to us that raising rates or not lowering rates is going to help financial stability, because it creates it creates more risk of bankruptcies and failures and losses from low activity. So it's sort of, it's not clear to us. It seems to us that probably this is not something that you want to, you really need to focus on the right tools, but we have to admit that this is an ongoing debate that we can't settle. Okay, so things, as Sina said, things that you could do in the future to try to prevent zero lower bound events from happening. Basically, we think that if, given the frequency which we think we're likely to hit lower bound events in the future, if you thought 10 or 20 years ago that 2% was a good target, and many people did, and including some of us, what have we learned in the past 10 years? Things that we didn't know 10 years ago are that maybe real interest rates have come down in a long-term way, and maybe hitting this bound is going to be a much bigger problem than we thought. And in face of that, if you thought 2 was a good number before, that would argue for something higher now, something that would get you away from that zero lower bound problem. And that's sort of, that is our conclusion. Okay. So one big issue that people have raised, including central bankers like Janet Yellen and Ben Bernanke, is if you raise the inflation target, will you lose credibility? Will you, once you raise it, will people think that, oh, you can go higher and higher and you'll unanchor inflation expectations? Well, we don't think that's a problem for a couple reasons. First of all, we saw New Zealand do it in the 90s, and they raised the target from 1 to 2 with little concern and unanchoring, and it's been stably anchored ever since. I think, more importantly, we think there's actually some evidence out there that the current targets of 2 are becoming a little less credible, because, in fact, financial market participants are concerned that central banks will undershoot, and you can see this not just in inflation expectations average levels, but also in options prices on inflation contracts. People are more worried risks. So, in fact, people are worried that target sustainably in the downward direction, and that's actually hurting credibility. If you had central banks choose a target that they could hit more durably and credibly, it actually would improve credibility, and that might be a higher, slightly higher target, 3 or 4% perhaps. We don't come down strongly on how much, and we certainly wouldn't want a very high target, but something higher. So we think that perhaps the way to do this is in a periodic process, not too frequently, but maybe every 5 years or so, to re-examine what we've learned as central banks and to reassess what we should aim for. So not basically, it seems to us that it's not credible to stick your head in the sand and not learn from reality how you've been hit. Now, one of the interesting parts of the report, but I won't have time to go into it very much, is that we actually show that the economy is moving in a way in which people might not need cash. You know, that's the paper money in your wallets. And that is sort of the thing, ultimately, that creates this lower bound problem. If that goes away, then a lot of these concerns go away, and that really changes the whole picture. We see this as a process that's happening, and in some countries it seems like it's gone quite far. But it's going to take a while. It's not an immediate answer to the problem, but it's just a trend that we see coming that may lead us to a point, not clear yet, but may lead us to a point in which this whole issue goes away. Central banks would be able to have negative rates if they wanted or needed, at least temporarily, to manage the economy, and that would be a good outcome. And maybe we'd all look back on this and say, oh, wasn't it strange that they had this bound problem on their policy? But that's more of a looking forward and not something that can be rushed. So just let me conclude then. We think that the recovery from the Great Recession was slower than we would have liked. Took a lot longer. Everyone's been talking about that for years now. We think also the perception of failure, that has driven a perception of failure out there that's actually harmful because it calls into question whether monetary policy did any good at all. We believe it did, but it could have done more. And nothing succeeds like success. If you actually do enough, you will validate beliefs in your policy and your ability to do good. And if you don't, you actually raise questions. And I think that's not good. So what is the firepower? Well, we think that policy rates below zero have been helpful at the margin, and they could probably go a bit more and still be useful. But second, we think that quantitative easing has been very helpful and could actually go quite a bit further too. And perhaps committing to a higher inflation target could be combined with those two policies to further help stimulate the economy. In the longer run, we should think about what the inflation target should be and think about infrequent reviews of what that should be. I'll stop there.
Thank you very much, Joe, and thank you very much, Signe. As expected, and as I hope you recognize, they stuck to their remit, but there's a lot of things in those bullet points that are hardly uncontroversial. And in a moment, we will turn to our distinguished discussants to raise perhaps some of those issues. I would like to just make one historical footnote apropos of Signe and Joe's remarks about raising the inflation target, which is obviously a very current topic. In '99, we published, not the Institute, published a book co-authored by Bernanke, Laubach, Michigan, and myself on inflation targets. And if you were to dust off your copy of said book, you would find that what we considered state-of-the-art in '99 included actually relatively frequent changes in the inflation target up and down, not as well developed a process as Signe and Joe raised, which I think is very intriguing. But that we put out very explicitly examples from New Zealand, Canada, UK, that reconsideration of inflation targets at intervals would be assumed to be part of the process. And that I view it as sort of an unfortunate act of naivete, at least on my part, I won't project for my co-authors, but that the inflation targets have since become sort of ossified like exchange rate pegs. Once they're in place, nobody wants to change them because, oh my God, we'll look bad. But if you channel Bernanke in '99, as was in the book he signed his name to, we didn't think inflation targets a priori should be so sticky and that there was room to change them. So just a historical footnote. For the real world, I turn to Dr. Jason Cummins, please.
So it's a pleasure to be here. Adam asked me a few weeks ago to speak on this paper, and I would do anything for Adam. And I thought, well, this is going to be a chore, but it was a great pleasure. It's customary when you're talking about a paper to talk about the paper. But I'm not going to do that today. For two reasons. The first reason is the Geneva report, and all of the reports, in my experience, are immensely valuable whole tomes on the subject. So I went through the paper. It's a long paper. And then I got to the second half. And it was all the comments. The comments were so smart. It's a bit like reading the annotated versions of Nabokov's works, where the annotations are 3 times as long as the actual paper and much more informative. So I'm not going to do that. I'll commend the comments to you. And I went through them all, and I thought to myself, well, I'm not going to be able to improve on that. The second reason I'm not going to talk about the paper is because the paper is too important to focus on the specifics in the paper. And I'm going to talk to you in the body of my comments today about what I mean by that. So in preparing my remarks today, I channeled the spirit of 2 intellectual forces from Peterson. The first is from Mike Musa. Musa taught me that central banks are never independent. They're only varying degrees of dependent on the public's trust. And because we've operated in our books for so long, we've lost track of the fact that America's first demagogue, Andrew Jackson, abolished central banking. Another demagogue, maybe more to your liking, FDR, also kind of abolished central banking. So what you need to understand about the broad script over time is that central banks do not have some independence imperative. Second point, Jean Pisani-Ferry, who has been associated with the Institute for many years, articulated, at least for me, in the most impressive fashion, the public's anger and distrust around Brexit, about expertise. People are tired of experts. They're tired of people like us. And yet I'm going to try and organize in a constructive way the points I want to make to speak to both this kind of audience as well as people outside this institution. So, specific points under Musa and Pisani-Ferry's intellectual umbrella. First, central banks are failing. And more importantly, they were failing before the crisis. Signe's chart was a very persuasive chart about the damage done by the crisis. But I think it misses a very important point that central banks before the crisis were also missing on their inflation objectives. So we're dealing here with a chronic problem exacerbated by the crisis, but not due solely, in particular, to the crisis. Secondly, central bankers' models are broken. The linkages between monetary policy and its transmission to the real economy through aggregate demand are normal sorts of models, whether it's at the Fed or elsewhere. The belief in those central banks is that those are structural econometric relationships, or at least if they don't actually admit to that, they behave that way in practice. However, it's my belief, at least, that behavior has changed over time, and that's an important feature to take into consideration when thinking about some of the features of this paper. Finally, the public is fed up with what's coming out of the Frankenstein lab of monetary policy. They've had enough. You know, the metaphor I've been working with in my mind can only actually be used in this room with all the smart people. It's like the court of Versailles before the French Revolution, where it was so insular and incestuous, you talked only in your own way and you had no idea what was going on in the rest of the world. So to be more constructive, though, at the end of my comments, I'll try and offer up some, hopefully, effective suggestions to address this. But I just want to make the point, I think if you had the public actually sit through Jackson Hole, they'd be aghast at what's going on. Aghast. Central bankers have no idea what they're doing. Oh, there's a smart guy who wants a big balance sheet. There's a smart guy who wants a small balance sheet. There's a chair of the Federal Reserve who says that everything we've done will actually achieve our objectives, even though she has not achieved her objectives. There are other people who say you should stop. If you had the public sit in on that, what would they conclude? So, first point, let's consider inflation. So we all agree that inflation is actually the thing that central banks can control, at least over the medium run. So let's look over the medium run. So this is a line chart where I've done two things. It's the year-over-year change in core PCE inflation, the Fed's mandated target, as well as a smooth version, which is the 5-year annualized average of core inflation. I drew a horizontal line there at 2%, which is mandate-consistent inflation. So, on a smooth basis, core inflation has been below 2% 90% of the time in this century. 90% of the time. On a year-over-year basis, core inflation has been below 2% 30% of the time. So you might say, oh, well, you're cherry-picking. Carmen and Ken told us the crisis is damaging. You're just looking at this incredibly damaged period. Well, I'm also looking at a period which was most flattering to create inflation. A dovish central banker, global growth that was off the charts, oil at $150 a barrel, rental inflation that was off the charts. And you know what we did? We managed 2% inflation a few times. So Signier's chart showing the big red parts of cross-country inflation being too low in the wake of the crisis, yes, that's true. But sometimes when you're so smart, you focus in on the details and miss the big picture. Central banking this century is a big failure. We have not achieved our goals as outlined by ourselves. Sorry, you were there fighting the good fight. Second point. This is more speculative. That's just a fact. More speculative. The thing I've been thinking about a lot lately is whether the linkages between financial conditions that central bankers can control and the real economy are broken. Let me show you a couple charts. They're not quite in the right order. Can I go? Okay, this one. So this is a little complicated because I actually did some work on this. So this is not just something you pull off. So this reflects effort. So the first thing, net worth to disposable personal income, that's a chart, line chart you all know, perhaps don't love, but are familiar with. Net worth to disposable personal income has a few features to it. The main features are the three humps. The first one was Mike Prell over there overseeing the internet bubble. The second one, I guess Dave's not here, but he oversaw the second bigger bubble, so he outdid you, Mike. And the third one, I guess we don't have any Fed reps here that I can see today, but the third one is the latest feature of wealth compared to income. So what you can see is that there are obvious movements in this part of the balance sheet for households. What I did in I'm colorblind, so I think it's the red line, the ratio, what's called there, the ratio implied from regression on the saving rate. What that is, that's like honest disclosure. What this is essentially is backing out from consumption behavior, actual consumption behavior of households, what they think or what they're behaving like is their wealth. So it used to be, to help fix ideas, it used to be that in the earlier part of the century, I gave people a lot of money, they spent it. And then, moving forward a few years in the housing bubble, I gave people some more money, different source. Instead of pets.com, it was your condo. They spent out of that as well. There was a cosmological constant when I was an economist at the Federal Reserve Board that 4 cents out of every dollar of your wealth would be spent on consumption. We argued interminably about the lags. Sometimes we thought it was 5 cents. Sometimes Dave Reitschneider would distribute it over different periods of time or different households. But you were required by your employment contract at the Federal Reserve Board to believe that 4 cents out of every dollar was spent on consumption. That is no longer true. So the saving rate, in order to help take you away from a pretty abstract thought experiment here, I'll just give you a simple point. Wealth has never been higher, almost never been higher as a share of your income, and yet what you see in the official data is the saving rate going up. Now it's gently going up. Maybe if you turn the sheet, you could convince yourself that it's flat. This should not be happening. What households have decided, and it may be because they're Ricardian, it may be because they're still scarred, it may be because they're behaving optimally and rebuilding their saving according to some kind of target saving model that is harder to specify. But households are behaving as if they don't have that wealth anymore. We're using the wrong model. We thought it was an econometric structural model where $1 of wealth gave you 4 cents of consumption, and it's no longer true. So you're sitting around at the Federal Reserve Board and other places, because actually this is a cross-country phenomenon, not just the Fed. not just the Fed's analysis of the economy, but other places as well. You're sitting around looking at features of the economy that are no longer true. You thought they were true. They're not true. People aren't spending. You know what? They got the wealth. They didn't buy another Silverado truck. That's the way it is now. So it wasn't a structural econometric model. It was just an empirical relationship from the past because people thought they were richer. Now people don't behave as if they're richer when central banks jack up asset prices. Again, it's not a political comment. These are just empirics. Okay. Second feature, business behavior. So obviously there are parts of the business sector that are highly distressed. The oil patch is contracting at a double-digit rate in every feature of its economic performance. The reason I put this chart on here is because not only is structures, which is the majority of what's going on in oil, but also equipment investment, it's declining. It's been declining almost a year. It may, this quarter, level out, but something interesting and important is going on here, beyond just the oil patch. Businesses have stopped growing their investment. So, you give households more wealth, they don't consume. Businesses, you give them an incredibly low cost of capital, they aren't investing. If I was still doing the forecast, and Mike was still there, he would be waterboarding me, saying, why is it the case that you don't have a stronger investment forecast? What's going on? The cost of capital has never been better. It's even going lower. I haven't even mentioned housing here. Is there any intellectual curiosity among this group and elsewhere why 3.5% mortgage rates have caused a decline in residential investment this year? Right? It's not just cherry picking one thing. It's business investment declining, residential investment being kind of flattish, let's hope for up, and consumption is growing, but certainly not in the way that we would have thought based upon the fundamentals. So I make that point that there is something in the linkages between financial conditions and the real economy that is no longer the same as it has been in the past. So why am I saying this? Obviously, kind of the raison d'etre of the paper is let's control financial conditions so that we can achieve better outcomes in our overall objectives, whether it's a Phillips curve translation into inflation or some translation into aggregate demand. I'm showing you basic stuff that's broken that we need to be talking about, and we aren't. Investment's been declining for almost a year. The saving rate is going up. Residential investment is down 2 quarters in a row. Okay, so to sum that up, so I just did a so the chief evangelists of Let's Raise Rates are the Goldman Sachs Investment Research Squad. And what they do is they plot FCI, Financial Conditions Index, and say, look, financial conditions are super easy. Here I've inverted it and then also brought it forward as kind of in a predictive fashion. They say, well, financial conditions are super easy. You know what we need? We need tighter monetary policy. Well, the other thing I plotted here is their own current activity index. Current activity has rolled over and died in an environment where financial conditions have never been easier. Literally, if you have, contrary to, some of your favorite regulators down the road, if you have a pulse, you can get a car loan. If you have a W-2, you can get a mortgage. These things are facts. They can tell you as much as you want the credit is tight. But you go to a car lot, I'm sure many of you have not been to a car lot in a while, but if you go to a car lot, you will walk out with 3 cars. And if you wanted to get a mortgage, they're going to want to give you 2. Current activity, not so great. Financial conditions, super easy. So you need to think about whether the linkages that we're studying in monetary policy are actually going to achieve your objectives. And I don't think there's adequate discussion of this. Third, this is my people are fed up. The folks at the Bastille are rising up. The maestro culture created by Greenspan has been one of the worst features of central banking. The public learned, because they were told this, that central bankers can control outcomes. Central bankers didn't even control inflation over a 16-year period. And yet they are tuned to believe, whether it's a town hall, official communications, the literature coming out of central banks, that central banks are all-powerful. We don't actually believe that when we have a cocktail conversation, but that's what the public learns when we talk to them. And, Joe, just as an aside, Joe mentioned, the abolition of cash. Cash is a bad thing. We need to get below the zero low rent. There's no greater evangelist for negative rates than I am in a textbook. You know what people don't like? People don't like chess grandmasters sitting around with other PhDs talking about getting rid of their money. That pisses people off. So you can titter, but it really makes people angry. So I'll have a fact for you. Ken's book has just come out. 67% of the reviews on Amazon, and there are many, are 1 star. I read some of the 2-star reviews, and I think he needs a bodyguard. The Frankenstein lab of monetary policy producing the world's greatest minds, a man who's going to win the Nobel Prize, books that the public is rejecting by 67% vocal, angry margins, is a broken model for central banking. And you need to wake up to it, because you are not going to have independent central banks in the next 10 years if you keep on this path. I showed you the behavior. People aren't consuming. Businesses aren't investing. They aren't buying houses when you have a 3.5% mortgage rate. What does this mean? You need to make the connection between that behavior and the incoherent anger of the populace that would vote for another demagogue that may make Andrew Jackson look like Abraham Lincoln. So I return to Moussa and Paisani-Ferry. Moussa taught me central banks can become a lot less independent. We've been living in the golden era of central banking. No volatility in the economy up to the great financial crisis. Great outcomes. It was fantastic. And the speech that Chair Bernanke will rue is not the one where he said some crime is contained. It's the one where he goes through a whole dissertation about how central bankers are in the main responsible for that. It was good luck. The econometrics say it's good luck if you talk to Jim Stock and Mark Watson. The change in the behavioral relationships tell you it was good luck. And we banked it as if we were the smartest people on the block. We aren't. Central bankers can go in reverse. Pisani-Ferry reminded me that expertise is in decline everywhere. People don't trust doctors. People don't trust the science on climate change. People don't trust. And we can, as he did in 3 or 4 ways, talk about ways to mitigate that. But you need to take it as an empirical feature of the landscape. So, Moussa and Paisani-Ferry, big shout out. Okay, what do I have to offer constructively, since I've ranted a bit? So, central banks need to start meeting their mandate and stop making excuses. So how do I do this? I mean, there are all kinds of smart ways to do this in the paper. I have a very simple pair of suggestions that don't go into the Frankenstein idea lab. First, appoint central bankers who actually want to achieve their mandate. Ben Bernanke, one of the greatest reflationists, living in the great reflationary age, weak dollar, $150 oil, rental inflation off the charts. He didn't do it. We're talking about, I sit around all day worrying about, small bore things that would just, just boggle your mind. We spend so much time on these things. So, worrying about whether the Fed's going to raise rates in September or December. It's insanity. Insanity. The Fed's plan to raise inflation is to raise interest rates. Do you want to go out and explain to the public? Like normal people, not even like the Rotary Club or something like that, where these people give speeches. Go out to the public and explain to them that your big plan to restore prosperity is to raise interest rates. Doesn't make any sense. You haven't met your mandate, depending on how you defined it, 90%, 70% of the time. And your plan now, in the midst of real, actual despair, weak fundamentals, if you want, is to raise rates? It's crazy. It's literally crazy. It is the court of Versailles talking about nobility when outside the court of Versailles, they're rioting. And we don't know it because we're just talking to ourselves. So achieve your central banking target by appointing central bankers who actually want to do it. It's much easier. I mean, you want to write a book about raising the inflation target? Why don't you just appoint someone who does their job? It's not complicated. I put on a tie sometimes. I do my job. Why don't they do theirs? I don't get the point of promising to slow the economy as soon as it reaches some rate of prosperity. I just don't get it. I'm not like some great populist. But it doesn't make sense to me. And it doesn't make sense to the public. So, those two things are eminently achievable. Appoint people who actually want to achieve their objective and actually stop talking about raising interest rates when you want to raise inflation. That's pretty simple. Don't raise interest rates when you want inflation higher. Why not sideline the discussion about raising interest rates by saying, look, Charlie Evans has a great idea. Let's just wait until inflation's actually 2%. You know what? Listen, Governor Brainerd gave a fantastic speech on Monday. It was a speech I wished I could give, and I wished I had heard from the chair. It took her almost an hour and a half, and yet it took her almost an hour and a half to utter the words, and this is a quote, 2% is not a ceiling. One of the foremost reflationists in the Federal Reserve System took an hour and a half to say 2% is not a ceiling. This is also crazy. Our best hope is someone who takes an hour and a half to say what is obvious to the public, which is stop trying to miss. My biggest worry is that the public is going to conclude, because of what we're doing, that capitalism is just socialism for the rich. We made David Tepper a billionaire through asset purchases. We're going to try and reflate by doing things that bankrupt key stakeholders in the society in insurers and bankers. And we're going to tell them that we're smarter than they are, and we know better, and we're going to achieve better outcomes, when for the entire century, we've failed. There's no more important topic. I'm sorry I didn't talk about the features of the paper. I kind of looked over Carmen's shoulder. She actually is going to show some real charts instead of rant. So in that sense, there's a happy ex post division of labor. But I really want to leave you with the food for thought that there's no more important subject. Great appreciation for Adam for giving me the forum to air these comments, and I appreciate it. Thank you so much.
Jason just said, Governor Brainerd gave the speech he wishes he could have given. Without saying I 100% agree with Jason, I should be so lucky as to give a rant as thoughtful and as provocative and as solid as what Jason just did. Thank you so much. We end with an even bigger bang. Professor Carmen Reinhart, please.
It's a pleasure to be here in my old stomping ground. I'm actually going to talk about the paper. I thought I would preface my remarks, though, by reminiscing. Morris, my dear friend, and I were, I think, in 1998 in Hong Kong at a Deutsche Bank conference. And much of the discussion in that conference had to do with the fact that Joseph Yam, the then governor of the Hong Kong monetary authorities, facing a speculative attack on the Hong Kong currency and a simultaneous attack on the equity market, had decided to intervene to keep the peg, but at the same time provide support for the stock market by purchasing equity. At that time, in 1998, this was thought heretical. I think it is a measure of how much the crisis has changed our thinking, that now Japan is doing purchases of equity that make the actions of the Hong Kong monetary authorities seem like child's play. So what I'd like to do is just in one slide recap the main message of what I took away as the main message of the paper. Jackson Hole, chairwoman Yellen, suggested that there are tools available in the event of recession, and this paper says, why should we wait? Unconventional policy can use up more resource slack, and a higher inflation goal can bump up the zero lower bound insurance. I very much enjoyed reading this report. I thought it was very thoughtful, both in terms of covering what we know and then moving on to what are possible options. I'm going to divide my comments into three parts. First, I'm going to try to bring in some historic context to this discussion, and in doing so, I would like to offer a critique, which is, I think some of the statements could be more nuanced. Secondly, I would like to highlight that it is a long report covering a lot of ground, but I would have liked to have seen more on regulation. The regulation of the financial markets has undergone a sea change since the financial crisis, and its interaction with monetary policy is a big topic. It's a big issue, and it impacts how monetary policy works in its transmission. And then I'm going to conclude by talking about what I agree with and what I do not agree with in terms of the policy recommendations. So that is my roadmap. Now, I am going to start by just a brief assessment of the effects of the post-crisis policies. And here, I am going to depart from both the paper and from Jason's conclusions. Certainly, Jason put it very clearly that he doesn't believe that central banks have been anywhere near successful. In BGHK, I'm sorry for it, but it's 4 authors, so I just abbreviate it. In BGHK, they do say, well, look, the outcome post-crisis has been disappointing. For the last 8 years, I have been trying fairly unsuccessfully to convince people that post-crisis recoveries are not the same animal as standard business cycles, that the degree of headwinds faced after a financial crisis is much, much greater. And I would highlight that because we do not observe a counterfactual, there's a tendency to compare to the last cycles, the last couple of cycles. And the inevitable conclusion has been, well, look, monetary policy really didn't deliver didn't really live up to its potential, and the recovery was too slow, and we needed more stimulus. These things are indeed said in the paper, but it's not unique to the paper. This is a conclusion that's often reached. We had not had in the advanced economies a synchronous systemic crisis since the 1930s, so maybe as a reminder of what that counterfactual could have looked like, and I am looking at Jason on this slide, this is the inflation performance for 22 advanced economies during the Great Depression and in the current crisis. So if indeed a systemic financial crisis produces major headwinds, there's the breakdown of the financial system, the monetary policy transmission mechanism is damaged, households and firms are over-leveraged, and the economy goes into a major slump. Well, what does this bar chart shows? This bar chart shows that the actual deflations that we saw in the early 1930s were to the tune of -4 to -14%. If that is a plausible counterfactual, then I would have to say that notwithstanding the fact that monetary policy started at low rates already at the outset, quantitative easing and forward guidance and other more conventional policies may be more successful than they are given credit for. If you look at the performance of output and compare the two episodes, you will draw a similar conclusion. I would note that also in that very vein, monetary policy did deliver negative interest rates, real ex post negative interest rates. It is true that we faced the zero lower bound problem fairly early on, but notwithstanding the incidence of negative real interest rates, post-crisis was non-trivial. I will show short-term rates later, but I wanted to highlight the difference between the 1930s, in which real rates were very high and positive. So my starting point is that before we plow ahead and say, well, much more needs to be done, although, as you will see, I agree with much of that, monetary policy, I think, has delivered in a way that is not often credited for. Now, I would note that the incidence of short-term interest rates in the current post-crisis environment are not nearly also as unprecedented as what one frequently hears in the financial press. We are in unprecedented territory. We are at the lowest nominal rates, but certainly real rates have been there consistently for extended periods of time before. And I would highlight that if we think of that there is an array of policies that are much more complicated, much more opaque, much more numerous, I would remind everyone in this room that if you look at the history of the Federal Reserve up until the era of the Great Moderation, a lot of the more unorthodox policies that are discussed in this paper were part and parcel of the standard toolkit. In effect, if you look from, I did with Ken with Ken Rogoff a couple of years ago a short paper on the centennial of the Fed, and if you look at many of the policies, and this now also extends to regulation, which I will talk to, but the very narrow definition of monetary policy of just having a single instrument, the short-term rate, and a very narrow mandate, a much narrower mandate of price stability is fairly modern vintage. So what this paper is discussing is not really that out of line with the longer history of our central banking. And just to highlight that real rates, one last picture on this, one last chart on this, just to highlight that real rates, consistent negative real rates are not a novelty. What this chart does is it breaks the history of short-term real rates in the advanced economies from the end of World War II to the present into three eras. The era that I have often referred to as the era of financial repression. I know that sounds sinister, but basically it's the era of much heavier-handed regulation, much more intersection between the Treasury and the central bank, and higher incidence of negative real interest rates. If you look at the dashed blue line, that is the frequency distribution of real rates for all the advanced economies during the financial repression era. The high real rates that we got accustomed to in the 80s and 90s was really the era of globalization and financial liberalization. And from the vantage point of the post-war era, more of an outlier than where we are now. This is a long-winded way of saying that the issue of being close to the lower bound, the issue of dealing with real negative interest rates has a long history, and perhaps what I would encourage the authors to do is to maybe look more into what some of those policies were between 1945 and 1970 that were also fairly effective in keeping nominal rates down. One area that I would like to be more critical of the paper is the authors often convey the impression that central banks really know what potential output is. And that there are these systematic relationships linking real interest rates and economic activity. I would put to you that ex ante, it is very difficult for a policymaker to know what is trend and what is cycle. And it is especially difficult when there are structural changes such as what we saw after the crisis. To highlight the unhappy experience of the 70s, I would note that for too long the Federal Reserve chased what they thought was their vision of potential output, which turned out ex post to be wrong. Potential output had moved significantly lower in the 70s, and the pursuit of higher output was, in the end, just inflationary. To highlight this, I have various vintages of the IMF forecast for world GDP growth, and what you see are systematic markdowns. So I would invite the authors to be more cautious more nuanced on what we do know about differences between trend and cycle, and what we know about potential output, and what we know about NIRU and equilibrium real rates. Post-crisis regulation. I will go through this quickly because I do want to spend time on the policy discussion. I think this is a missing ingredient in the paper, and the reason that I think it's a very important ingredient is significant regulatory changes have created a demand for risk-free assets. Liquidity ratios have been introduced, not just in the US, but worldwide. The cost of intermediation has changed significantly for banks. And in effect, this year's Jackson Hole was importantly also devoted to seeing what some of the effects of these regulatory changes were on not only the transmission mechanism of monetary policy, but also, importantly, their potential impact on financial stability and on real interest rates. In effect, the latest FOMC minutes also acknowledges this point, indeed. So I'll drop it there, but I think that is food for thought. On the policy recommendations, let me turn to this. Raising the inflation target. I am far more comfortable, I'm actually fairly comfortable with this recommendation. In addition to the arguments that the authors make about providing more safeguards against hitting the lower bound during bad times, for the past 6 years, I've been saying in periods of high leverage, a moderate and steady dose of inflation was actually quite constructive in reducing the size of balance sheets. And it was a fairly effective way of liquidating debt for the advanced economies almost without exception. The range is not significant, but the financial repression tax, which was delivered with inflation that seldom rose above 4%. So we're not talking about the 1970s here. Let's be very clear about that. We're talking about the earlier era where inflation did oscillate between 1% and 4%. In the U.S., admittedly, it was lower than most advanced economies, but it was still safely within that range. Now, where do I really run into problems or disagreements? And here I tend to actually share some of Jason's views on what central banks should or should not be doing. I have a problem with the central bank taking on fiscal policy. And when we get into, let's start with the most obvious, the helicopter money. Helicopter money is really, should be in the hands of the Treasury. People do not vote for central bankers. The policymakers who do get elected opted not to do these things. And what makes it that the central bankers know better and without being elected should engage in these kinds of transfers? To me, that is moving in the direction of taxation without representation. I think the idea of households getting checks from Chairman Yellen in a helicopter exercise is a little will put you well underway of losing central bank independence one way or another. Now, let me backtrack and say something about negative interest rates. Negative interest rates are also a tax. They're a tax on banks that will be passed to depositors and to borrowers. They have important redistributive effects and are completely opaque, meaning nobody votes for them. The financial repression tax, by the way, is also a tax that is opaque. And there is something to be said for opaqueness, and, but I'm not going to go that route right now. Let me also conclude on this part of before I get into the issue of central bank independence and conclude, actions by the central bank, and this does echo something that Jason said also, can preclude what could be potentially first best solutions. In other words, if bank balance sheets need to be cleaned up, is it not the first bet to actually clean up the balance sheet rather than have Mario Draghi buying corporate paper to help clean up the balance sheet so that the credit channel works again in Europe? So central bank action can actually be a second best that may preclude some first best solutions. So last two slides. There's more than one way of losing central bank independence. And the traditional one that everybody thinks of is where the central bank is the passive financier for the government. But what we're seeing here is quite different. Is the central bank wanting to take on fiscal responsibilities and acting as both treasury and financier. And, if it may be that, this comes about because the people doing fiscal policy are inepts. But I would highlight that those inepts are usually the ones that drafted the charter for central banks and may decide to change their mind. Last observation, I know we're overdue. What about cashless? Okay, I think the issue that in different parts of the world, financial systems are moving towards a cashless or less cash than in the past at different speeds. That's fine. That's an organic outcome. However, I would note that any measure that penalizes cash holdings. In the old days, we would call them capital controls or the like. In effect, if you look at May 1, 1933, at that time, President Roosevelt was concerned that people were hoarding gold, and the law to abolish gold hoardings, everybody had to surrender their gold. Now we're talking gold has replaced cash, and I am very, very skeptical that as much as I may like some elements of financial repression, maybe this is a little bit too much. I know this is not a central point of the paper by any means, but since you devote some discussion to this, I thought I would conclude with some observations on that. And to reiterate, I really think this is a significant contribution, and that if I had to bet, I do think we are going to move to higher inflation targets, and understanding that sooner rather than later is high value added. And I'll conclude there.
Thank you so much, Carmen. If I can invite Carmen, Jason, and BGK to come up on stage. We've run over because the content was simply outstanding. We will take questions from those remaining. Just a note to our friends online and to reassure everyone, we will by tomorrow have up the transcript and the videos of this session. So not only can you already download What Else Can Central Banks Do, the Geneva Report by BGHK, but you will be able to download and watch and review the comments by our two distinguished discussants. One last note before we start. Carmen, like I, was at the Jackson Hole conference, and I think we both saw a lot of what Jason was referring to. I mean, we had papers about people, central banks potentially issuing their own bills. We had discussions that do seem rather strange in a world where people hoard guns and avoid the idea that they wouldn't get a little annoyed if people took away their cash strikes me as odd. That doesn't take away anything from, however, our discussions today. I'm designating Larry Ball, who did not present, as the main responder to questions on the main report. But let's open it up. We have a microphone in front and a standing mic in back. Would someone like to offer a question or comment?
Not to be too bossy, could we reply just briefly?
No, because we're out of time.
No. All right.
I already bossed.
All right.
Next question, please. Anybody?
Jeremy Cohen-Seton from the Peterson. I have two quick questions. One is a follow-up from Professor Reinhardt question about the uncertainty about future potential growth, or the uncertainty about the decline of the real interest rate. So I was wondering, your report is a lot about focuses on the decline in the point estimate, but doesn't really address if that increase in uncertainty should lead to a different monetary policy framework. The second quick question is to Professor Reinhardt. I was curious to have your view on the difference between FDR's reflation effort in the 1930s and Abenomics, and what you see as the difference between the two. Is it the fiscal drag that explain why Abenomics hasn't worked as well as the reflation policies of FDR, or is it something different?
Yeah, and also our authors may also want to comment since they discussed Abenomics in the paper. But Larry, why don't you start off on the first question?
Which was the first question?
R-star.
Potential growth.
Okay. I think there's a lot of uncertainty about R-star. I think what maybe one thing I would emphasize, actually, in a sense, and my views are correlated with my co-authors, maybe not exactly the same. The R-star issue is maybe even a little overemphasized in the sense that even if we assume that R-star is 2%, as John Taylor did in the 90s, the results aren't that different. I mean, we have this simulation that says if unemployment goes 1.1% above the natural rate, you'll hit the zero bound, so that will happen all the time. If you recalibrate it so R-star is 2%, I think you get that unemployment has to go 1.4% above the natural rate or something like that. So still, with the 2% inflation target, you're on very thin ice that a modest downturn will push you up against the bound, and that's pretty robust to what R-star is.
Great. Carmen, do you want to comment on the historical comparison of FDR and Abenomics?
The reflation efforts in the U.S. Came when inflation was oscillating between -5 and -10%. The deflation was very significant. The Japanese approach towards balance sheets was also dramatically different. So initial conditions were very different. And the whole approach to balance sheets. In Japan, balance sheets have been preserved. We've lived with extend and pretend, which lengthens the process. So bottom line, what we see in the 30s is a much sharper collapse and therefore much more upside, potential for rebound than what we've seen in Japan, in which the initial collapse is simply not there. So the process may drag on and drag on. It's a tip of the iceberg, what I've said, but I'll leave it there.
Great. Pedro.
Hi, Pedro da Casa here at the Institute. My question is for you, Jason. Really enjoyed the presentation, and I had some sympathy for the notion that a lot of this monetary policy discussion gets very insular and intellectual, and that it may be interesting to us, but the general public might kind of laugh it off. But I wanted to nail you down on what your policy prescription might be, because when you started off, it sounded like you were saying that by tinkering too much, that monetary policy was ignoring the fact that it was being ineffective, and therefore that policymakers have perhaps done too much. But then you ended your presentation by saying that actually they've been falling short of their target, which implies that they should be doing more, and therefore perhaps delving into some of the tools these guys are presenting. Could you square that circle a little bit?
Sure. Thanks for the question.
Could you hit the on button, I think?
Thanks for the question. Can you hear me?
No.
Does that work? Okay. Thank you for the question. I like simple. And so what I was trying to say, and maybe it got buried in the rant, was a simple policy would be to stop doing things that don't make sense and start explaining to the public a very simple policy rule. Taylor rule, too complicated, too many parameters. Just do something simple. So what I think the public's hearing now, and it's metastasized into the Fed zone and the Michigan surveys, inflation expectations, and certainly it's prevalent in the market, is deflationary mindset or a disinflationary mindset. As Governor Brainerd pointed out, and, again, there's 17 people sitting around that table, and she's really the only one in a fulsome way pointing out that inflation expectations are unanchored on the downside, which hasn't happened in our lifetimes. So what you need to do is stop explaining to the public then when the economy succeeds, you're going to punish it. It's very Japanese. We sat around a decade ago making fun of the Japanese as if they were some spandrel, irrelevant to history. They aren't irrelevant to history. The math, the economics, the sociology, the politics, they were just before us. And what the central bank did was either declare defeat or said, whenever we're going to succeed, we're going to punish you. Doesn't make any sense. So a sensible policy is one advocated by my public policy betters, Larry Summers, former President Kocher Lakota, somewhat quietly because he has to remain within the confines of the system, still in Versailles, if you will, Charlie Evans. They say, look, what's the rush? Why are we using models? I was taught a long time ago that macro dynamics are only identified by rare events, crazy things that happen. What we actually know as macroeconomists, not that much. What we know about normal times, almost next to nothing. I mean, it's really kind of funny, right? So what we need to do is go out and say, look, why are we using a model from the 70s? We're taking a Phillips curve that was identified off extreme behavior in the 70s and using that to drive policy now when we all agree that's irrelevant if we actually sat around and discussed it. You read a speech like one by President Williams. Third or fourth paragraph in his last speech, he says, the economy is running hot. Well, it looks like a speech that was written 2 or 3 years ago. There's no sense in which the level of activity is above potential in a way that's generating hotness. There's no sense in which you're cruising along so fast that you're going to blow through the level of potential. It's a speech not anchored in reality. The charts I showed. And so I would just say to people, look, we're not raising rates until we get to 2%. I don't have to do anything fancy like the inflation target and have one of the foremost academics in the study of monetary policy, literally someone who wrote the book on this stuff, explain the costs and benefits of higher inflation target. Just go out and give a speech saying we're not raising rates. And then people like me could go on and do other stuff than worrying about whether they're going to raise rates in September or December. It's crazy to be having this conversation. Crazy. And yet we are.
I think I should let Larry and Carmen and maybe Joe, if he wants to also comment on this issue.
Well, I'm basically very similar. I mean, the Versailles analogy certainly resonates with me, speaking for myself. And I think maybe even I'd propose the amendment that they say we're not going to raise rates until inflation is 3% or 3.5% or something. I mean, we've erred enough on the side of caution. We really need something pretty aggressive, I think. And again, on the Versailles, the speech about Williams, of course, Reifschneider, the history is interesting. Reifschneider and Williams were the ones who proved in the early 2000s that the chance of hitting the zero bound, the 2% inflation target were very small. And Williams now seems to have learned a little bit from history and is a little more equivocal. But I guess I haven't read it carefully. I guess Janet Yellen is citing Reifschneider's latest research and assuring us that, with the 2% target in most circumstances, we're okay, nothing to worry about. And that does certainly have a not paying attention to the reality of the last 10 years flavor to it to me.
Carmen?
I would note that, again, I echo some of the sentiment that rate increases or normalization, it should be a very gradualist process. But I would note that we really don't know what potential output is. And I think the idea that saying the economy doesn't look hot because it isn't growing the way it was 10 years ago, 15 years ago, it says nothing. It just, for all we know, we could be at potential right now. But I completely agree with the policy prescription, that if one wants higher inflation, why stop even if you're at potential?
Thank you. Joe?
I'd just say I agree with Jason on the current situation, but I would just say, put yourself back in 2009. Would it have been enough just to say, well, we're going to keep rates at 0 until inflation is above 2? I think more would have been needed then.
Very good. Ted, you can have the last question.
Thank you. Ted Truman from the Peterson Institute. Isn't one of the issues here that, and I don't know whether you guys I only read the earlier version of the report, so one of the issues here is that central bankers, all warriors fight the last war, and the last war, at least still for most of the central bankers of the world, was inflation, not deflation, right? We haven't gotten that. That's this war, right? But we're still fighting the last war. And the people who articulate that war, right, are people who grew up in the 70s and early 80s, right, where we had high inflation, and the cost of bringing inflation down was very high. In fact, it was a global financial crisis. Carmen, I would count the early 1980s as a good example of a coordinated global financial crisis in terms of both growth and other things that were going on. Not on the order of the 30s, but post-war. And so the problem is, those people worry about inflation, and the Volckers of the world, if I may put it that way, worry about why can't price stability be price stability, and price stability is zero inflation. And so maybe you could comment on that aspect of the question, and whether, in some sense, by moving the inflation target, you actually ignore, or what do you do about the sort of costs of inflation? And there's a big literature on the costs of inflation. Maybe that's changed somewhat, but it tends to drive one down to something like 2. It could well be 3 or 4. I accept that, but comment on that. Thank you.
I suggest we will let Larry have the last word, but if anyone wants to comment before Larry. Oh, okay. Oh, Jason. Oh, you look eager. Okay.
Okay. So since Larry's going to get the last word, I'm going to answer the question that I wished you had asked, which is sort of embedded in the question that you did ask. You touched briefly on the kind of history of what's going on in central banking by mentioning the 70s and the very material social welfare costs of inflation in that period of time. An observation suggested to me by Ken, Carmen's esteemed co-author, which I've ruminated on many times, is that central banks essentially rewrote their DNA in response to that episode and have not revisited it. And it's going to take, I mean, it may be because the public actually does a whole Bastille and overthrows the royalty in the institution. But I think over the next 10 years, we're going to see a rewriting of that DNA to undo the Volckerness. And some of that is embedded in the Geneva report where we're experimenting. I mean, it is a pejorative for me to call it the Frankenstein Idea Lab, but it's necessary to have this kind of debate in order to surface these points, in order to rewrite the DNA so that we don't have the foremost reflationists on the Federal Reserve's board talking about 2% is not a ceiling an hour and a half after she began to speak. It's going to take 10 years minimum to redo this stuff. And I was glad you mentioned the 70s, and I just wanted to point out that what we need to be doing is rewriting that DNA so we actually have some hope of achieving mandate consistent inflation. Forget about all the other stuff. I mean, smart people want to talk about hard topics. I got a kid, sorry, just 1 second. I got a kid who wants to talk about hard stuff. And then he'll fail easy tests. When you have a pupil who fails an easy test, that's the worst outcome of all. And I pointed out to you that over this century, we're talking about really hard stuff. I mean, the financial crisis, all this stuff. I mean, Larry's paper on Lehman and so forth. I mean, really, really, really hard topics. But you know what? Before that, we had an easy test and we failed it. What do you do with a kid who fails an easy test? Do you give them the harder test and then let you go out and do all this crazy stuff? No. We got to figure out just the basics and rewrite the basics and get rid of the 1970s. I'm sorry you were there actually in the institution as the person in the audience who's most familiar with this, and I'm trying to, kind of bring out your point. We need to stop and fix it.
For what it's worth, before Larry does get the last word, and obviously it wasn't worth much, I gave a speech while I was on the Monetary Policy Committee at the Bank of England saying this is not the 70s and calling on us to forget that. And the speech was, of course, forgotten. Larry.
Well, briefly, I think we did learn in the 70s that inflation is costly, double-digit inflation, and there is a large literature on the cost of inflation. And our reading of that literature is that the difference between the costs of 2% inflation and, let's say, 4% inflation is pretty trivial. And in contrast, the benefits of having an extra 200 basis points of easing before you hit the lower bound is large. So just on a cost-benefit analysis, I think seems to us not even close. I think some people, including Ben Bernanke and Rick Mishkin and Orthodox people, have said, well, of course, 4% inflation per se isn't that costly if it could really be stable, but we'll lose credibility, and if it's 4, it'll become 6 and become 8, sort of. And again, we discussed this at length in the report that we don't think that acting as though 2.0 must be in some religious text, and we cling to that regardless of anything. Even though we can't really meet that because we can't use our instruments, that's especially good for credibility, and that saying actually, I didn't actually. It's been a while since I read the four-authored 1999 book, but
it's okay.
Saying that having an inflation target has some good properties, and we should periodically rethink what's the optimal inflation target based on learning from what's happened to the economy, that doesn't seem especially destructive of credibility to us.
Thank you very much. Thank you all. I think this has been a spectacular session, obviously building off the terrific work that BGHK, Krogstrup, Gagnon, Ball, and Honahan, who's not with us today, did in the Geneva report. But also, obviously, Carmen Reinhart and Jason Cummins did an incredible service to this institute, but also to the public debate by meeting that quality of report with equally brave and insightful discussion. We're going to promote the hell out of this because I think this is an important contribution to what are critical issues. As Jason said, we're stuck with the hard test, even no matter what our performance was on the easy test. And I'm grateful to our authors, led by Joe, who brought us this project, to grapple with this in such a practical, analytical way. Thank you all very much.